Today, we're digging into the Nobel-winning ideas of Robert Mundell. He's the economist who basically built the intellectual architecture for our entire global economy. And the wild part is, his theories from way back in the 1960s are so on point, they shape everything from the euro you might have in your wallet to how your government fights a recession. So let's explore the rules he uncovered.
All right, here's how we're going to break it down. First, we'll tackle the core puzzle that every single country has to deal with. Then, we'll get into Mundell's toolkit, starting with the Mundell-Fleming model. That leads us to an unbreakable rule he discovered, the impossible trinity. After that, we'll get into his most radical idea, the optimum currency area, and wrap it all up with his incredible legacy.
You know, before Mundell came along, most economic models treated countries as if they were little islands, completely separate from one another. But we all know that's not how the world works, right? In a world where money and trade flow freely, policymakers are always caught in this fundamental tug-of-war.
And this is the heart of the matter. Can a nation truly control its own economic destiny while also being totally open to the rest of the world? Well, it turns out you just can't have it all. And Robert Mundell was the guy who figured out exactly why and what tough choices have to be made.
Think about it like this. On one side, you have a government trying to manage its own house, right? Focusing on things like jobs and keeping prices stable. But on the other side, once you open your doors to global markets, you're constantly being pushed and pulled by money zipping across borders and currencies bouncing all over the place. These two forces, they're often in a head-on collision.
And this is exactly the challenge that Robert Mundell tackled. The Nobel Committee even called his foresight almost prophetic. Why? Because he wasn't just solving some dusty academic problem, he was literally handing policymakers the essential toolkit they needed to navigate the globalized world we live in today.
So, let's open up that toolkit. Mundell's first major contribution was a whole new way of thinking about open economies. He developed it back in the early 1960s, and it quickly became the absolute standard for policymakers. It's still essential stuff for understanding international economics.
Okay, so what did he do? In simple terms, Mundell took the standard economic model of the day, which, remember, treated countries like those self-contained islands, and he plugged it into the rest of the world. He added things like foreign trade and, this is the crucial part, how money flows across borders looking for the best return. That one simple addition, well, it completely changed the rules of the game.
And his model led to this absolutely stunning conclusion you see right here. The power of a government's economic tools depends entirely on its exchange rate system. Check this out. Under a fixed rate, if you try to boost your economy by cutting interest rates, money just floods out of the country to find better returns elsewhere. Your policy is basically useless. But government spending? That works. Now, flip it. Under a floating rate, the complete opposite happens. Cutting interest rates is now super powerful because it also weakens your currency and boosts exports. It's like your entire policy toolkit gets rewired based on this one single choice.
This incredible insight from the Mundell-Fleming model leads us right to his most famous concept. It's a fundamental limit that no country, no matter how powerful, can escape. People often call it the policy trilemma.
Here's the core idea, and it's so elegant. A country can chase any two of these three goals, but it can never, ever have all three at once. You can have a stable, fixed exchange rate, you can allow capital to move freely across your borders, or you can have your own independent monetary policy. The catch? You gotta pick two. So let's look at the trade-offs.
Okay, option one. You choose a stable exchange rate and you keep your financial borders wide open. To make that happen, you have to give something up, your independence. Your central bank's main job is no longer managing the local economy. Its only job is to defend that currency peg, no matter what.
Option two. Let's say you really want that stable currency and you want to be in control of your own monetary policy. Well, to get both, you have to give up on free-flowing capital. You have to build walls, what economists call capital controls, to stop money from rushing in or out of your country whenever it feels like it.
And that brings us to the final option, the one that most major economies like the US and Canada have picked. You can have your capital flow freely and let your central bank run its own show. But what's the price? You have to let your currency float, to go up and down with the whims of the market. That's the trade-off.
So just as the world was trying to get its head around these massive trade-offs for national currencies, Mundell was already miles ahead. He posed an even more radical question, one that challenged the very idea of a national currency itself.
Get this. In 1961, years before the old Bretton Woods system fell apart and decades before anyone was seriously talking about the euro, Mundell published this paper.
And in it, he asked a question nobody else was even thinking about. What is the right area for a single currency? Should it be a nation, or could it be something else entirely? This was just so far ahead of its time.
Mundell's logic, right here in his own words, was basically that we shouldn't stop thinking at national borders. He argued that the perfect place for a currency isn't necessarily a country defined by a line on a map, but a cohesive economic region, a place where it just makes sense for everyone to use the same money.
So, what makes a region optimum for sharing a currency? Well, Mundell said the absolute key ingredient is labor mobility. Think about it. If one part of a currency union gets hit by a recession, you no longer have a flexible exchange rate to soften the blow. So instead, workers need to be able to pack up and easily move to another part of the union where there are jobs. The people themselves become the economic shock absorber.
And this is where the story gets really wild. What started out as this super niche academic idea would eventually become the blueprint for one of the biggest economic experiments in all of modern history.
Just look at this journey. His 1961 paper lays down the intellectual groundwork. Then, in the 70s, the old system of fixed exchange rates collapses, and the world is desperate for new ideas. Fast forward in 1999, and boom, Europe launches the euro. It was a real-world test of Mundell's theory on a continental scale, almost 40 years after he wrote it.
So Mundell's theory basically gave us a checklist for any group of regions thinking about creating a currency union. To have a good shot at success, you need more than just mobile workers. You also need capital that can flow freely to where it's most needed, economies that are diverse enough so that one industry downturn doesn't sink everybody, and, this is a big one, some kind of system to give financial support to regions that are struggling.
Which brings us right up to the present day. So does the Eurozone actually tick all of Mundell's boxes? Well, that's a huge debate. The ongoing arguments about things like labor mobility between countries and whether there should be a stronger shared budget, it all shows just how incredibly relevant Mundell's framework still is. The challenges the euro faces are, in many ways, a live stress test of his ideas.
When you step back and look at the big picture, it's just undeniable. From the impossible trinity that dictates policy choices in every country to the theoretical blueprint for the euro, Robert Mundell's work laid the very foundation for how we understand economics in our interconnected world.
And his work really pushes us to think even bigger. He didn't just stop with Europe. He wrote about the idea of an Asian currency and even explored the case for a single world currency. So we're left with these huge, forward-looking questions he raised. As our world keeps getting smaller and more connected, what is the ultimate endgame for money? That's a question Robert Mundell gave us the tools to start answering.